I'm Chris. I work at Nikko Asset Management as a portfolio manager in the fixed income team. And so that means I look after the bond fund, making investment decisions and the day-to-day operations. So the task that we've set here is meant to be doing some analysis on 2 credit issuers and then trying to pick a bond. So that's going to have 4 parts. The first part is doing some initial screening and analysis on the 2 issuers. The second part is building a yield curve to look at the bonds of those issuers before picking a bond, and then finally we'll be stressing some economic information and having you rethink about that position. So fixed income is lending money to issuers. So if you think of an equity investment, you buy a share in the company. In fixed income, you'll be lending money to a company. So it's generally much safer than equities. The role that it plays in a portfolio is typically through diversification. So because it's safer, when risk assets sell off, typically fixed income does well, and that means you get some diversification. The other benefit as well is that because it's fixed income, if you're looking for a stable income stream, it's another class that you can use to generate that income. So when we're evaluating things, to keep it in context of this task, if we're looking at credit, we really want to know the chance of default in that issuer. So because we're lending money, we want to make sure that we get it back. And that means we're going to be looking at things like profitability, their coverage ratios, how much debt they have, their credit rating, and using that to get a feel for just how likely it is they are to repay us. Once we've decided to lend a company money, we need to also do some analysis of how expensive or cheap it is. Generally that's called relative value. And what we'll do then is we'll look at the yield that bond returns compared to its peers, and then we'll try to pick out a bond that looks the best compared to its peers. Good luck, and I hope you enjoy the task.